Good morning, students. Namaskar, Suprabhat, Sat Sri Akal, Vanakkam, Kem Cho, etc., etc. We are discussing, we will be discussing today the provision for income from other source. The last head of income, like we have 5 heads of income, you all know about it, like salary income, income from house property, business income, capital gain, and the last is income from other source, but not least. Every head is important, every chapter is important, every provision is important because CA is important. And that is very important for you to becoming a chartered accountant. So once again, good morning. I am your faculty CA Ankit Sharma, and this is the test your knowledge question regarding that chapter. We have only one session for it. Then MCQ test will also be there. There will be a story, of course, as usual. And of course, let me take some good morning from you. Like Kavita is good morning. Okay, Rajesh, good morning. Bhumika, good morning. Komal, good morning. Darshan, good morning. Ravijeet Kumar, good morning. Darshan also send a query. He always do so. Good habit. Not a problem. Okay. Diksha is saying good morning. Rajesh, good morning. Deepanshu, good morning. Manisha, good morning. And Vishwanatha Reddy, good morning. So a very warm welcome to all of you from my side. And we will be discussing income from other sources. Before that, I want to ask a simple question, a very simple question from all of you. What is the opposite of failure? Please tell me what is the opposite of failure. If I'll ask you what is the opposite of failure, what should be the answer? What is the opposite of failure? It might be, okay, so Bhumika is saying success, Sushil is saying success. But from my point of view, today's thought for the day is saying something else. It says failure is not the opposite of success, it is part of your success. Read it carefully and just try to understand this, that this is exactly right. Failure is not the opposite of success, but it is the part of your success journey. So if you are successful, definitely you would have some kind of failure in the journey. So failure is not technically the opposite of success. In a practical life, in a journey of your life, definitely it is part of your success. So if you are a chartered accountant, there must be failure. Of course, there must be some failure. But your success means definitely there should be some failure, because if there is any invention, that invention take place after a lot of failures, etc. Fine. So that was a thought for the day, that failure is not the opposite of success. Technically, it is your part of your success. Okay. Okay. So there is some query, and let's see what Darshan is asking. STT, that is Security Transaction Tax, is not a part of expense on transfer, sir. Tax on dividend. So he's two queries. First is STT is not a part of expense on transfer. STT will form your part of transfer, not under the head capital gain. It is not treated as expenses because due to payment of STT, you would have some benefit under section 111A and 112A. So under section 111A, if you paid STT and your gain is short-term capital gain, the tax rate will be 15%. That's an advantage. It is not going to be taxable at slab rate. Clear? And if it's long-term, then again, you need to pay tax only with the rate of 10%. So STT gives you benefit under capital gain chapter if shares are yours, not your stock in trade, they are your capital asset. So they are not expense on transfer, but technically they give you advantage in another way. But if shares are your stock in trade, and if in that case you pay STT, then STT can be claimed as your business expenditure. This we have already actually discussed in PGBP head. The second question is asking, tax on dividend income is based on slab rates. Yes, the tax on dividend is taxable under the head shareholder now, and under the head income from other source, and it's going to be taxable as per slab rate of that person. Okay, Piyush Khurana is asking, in order to claim exemption under section 54B, D, 1037 that the assessee to be used for agricultural purpose and for industrial purpose immediately preceding the date of transfer. So my question is, it is necessary to use that very, I guess you are asking every asset for complete 2 years preceding the date of transfer. Yes, of course, to claim the benefit of section 54B and D and for exemption of section 1037, it should be used for at least 2 years preceding the date of transfer for the respective purpose. Further, if it is used for complete 2 years, that it will become LTCA as per period of holding. Then how we can claim exemption for STCA under section 54B and 54D? Under section 54B, technically, you cannot claim exemption if it has not been used for at least 2 years. Earlier, there was limit for 3 years. Let me tell you, land and building becomes long-term capital asset after 36 months. Earlier, like 3-4 years before, it was not 24 months, it was 36 months. So in that case, section 54B and D was same. It says 2 years. But when the provision of long-term capital asset definition has been amended up to 24 months, then you are right. It is technically not possible to claim benefit under section 54B or D, we can say, if it is a short-term capital asset. So technically you are correct. After 24 months, it becomes long-term capital asset, but this exemption was already there. But the provision of becoming an asset like a long-term capital asset has been updated. Earlier it was 36 months. Then in this case, 2 years limit was, of course, we can apply. But now it's 24 months. So practically or technically you can say yes. Now that is irrelevant. I hope it's clear, Mr. Piyush Kurana. You can see like 3-4 years before the definition of long-term capital asset, in case of land and building, it was 36 months. Okay. Darshan, sir, if possible, please come for an additional revisionary session, sir. I will be really happy if it is happening, but this is the power of board of study. They will decide what they are doing. And let me tell you, they are doing really good. We all should thankful to the board of study and ICAI, because what they are doing, nobody doing in this whole country. They're providing you free lectures with superb faculty and doing a lot of hard work. So please always thankful to your board of study and ICAI. Okay. Kavita is saying, I attended a YouTube PGBP and capital gain question solving live lecture. Very good. I was able to solve almost all questions as you have made provisions so easy that I did not solve, they just got solved. Well done. High five from Wi-Fi Kavita. If it is happening, if you are able to solve or all of you are able to solve or actually understood the provision easily, that's what we all want. That's what I want. That's what the board of study wants. That's what ICI wants. That's your parents want. Everybody wants this, and you are really doing a good job. Very nice. So you should saying, okay. Now we are moving on to our today lecture. That is income from other source. So income from other source is our last head of income. And it's really easy to understand what income should be chargeable under income from other source. Like any other head, we need to understand what kind of income is going to be taxable in that head actually. Like for salary, charging section 15 says, there must be an employer and there must be an employee. And the payment flow between them will form salary. Income from house property, charging section 22 says, there should be a building, there should be some income. It should not be used for the purpose of your business and profession. The assessee should be owner or deemed owner. Clear? Section PGBP, section 28 says that if you earn any income directly or indirectly for doing business activities or not doing any business or professional activity, generally they are going to taxable under PGBP head. There is a lot of provision in section 28, but the summary was this. Charging section of section 45 of capital gain says if there is a capital asset and if there is a transfer, then that is going to be taxable in the previous year in which transfer took place. So we technically in all the other heads try to understand what kind of income is going to be taxable under that particular head. But income from other sources is very sorted. It's very simple. It's very easy. It says that if any income is going to chargeable to tax, and it is not included in any other head of income, those 4 head of income, that if it is not going in any other 4 head of income, then it's going to be chargeable under income from other source. So technically, income from other source has no definition regarding what kind of income is going to be taxable under income under the head income from other source, but it says if any income is going to be taxable under income tax and is not included in other 4 head, that is going to be taxable under income from other source. तो वो हिंदी में होता है ना, जिसका कोई नहीं होता उसका खुदा होता है, ये वही है जो कहता है जिसका कोई नहीं है वो यहाँ के taxable होगा. So if there is any income which is not going to chargeable in any other head of income, that is going to be taxable under income from other source. For example, like we have interest income, bank interest income, saving bank account interest. So can it be taxable under salary head? No. Can it be taxable under capital gain? Of course, no. Can it tax under PGBP head? No. House property? No. So where is going to be taxable? Under income from other source. We have dividend income on shares. It cannot be taxed under 4 heads of income. So automatically it's going to be taxable under income from other source. So if there is any income is given in the question, and if you are not able to put that income in any other head of income, then automatically is going to be taxable under income from other sources. Clear? So the quotation is, it's not important to win all races of life, but to finish every race with best effort is important. So you should give your best effort, and let me tell you, if you are giving your best effort, there's nothing you cannot do. You can achieve anything, anything. So just give your best effort, and other thing, destiny will handle. So income from other source, introduction part, any income, profit or gains includable in the total income of an assessee, which cannot be included under any of the preceding heads of income. You can see what it is saying. It says, which cannot be included under any other head of income is going to be taxable, is chargeable under income from other sources. Clear? So that income which cannot be included under any of the preceding head of income, that is going to be taxable under income from other source. Clear? This So therefore, when any income, profit or gains, thus this head is the residuary head of income and brings within its scope all the taxable income, profits or gain of an assessee which falls outside the scope of any other head. Therefore, any income, profit or gain does not fall precisely under any of the other specific head, but is chargeable under the provision of the Act. It would be charged under this Act. So this whole paragraph is just saying the same thing, that if any income is going to be taxable, but it's not able to tax under any other head of income, is going to be chargeable under income from other sources. So income chargeable under this head, the income chargeable only under the head income from other sources are, there are some specific income, those are going to be taxable only under the head income from other source. Specifically, like if shares is your stock in trade, even then dividend is going to be taxable under income from other sources. If shares are your capital asset, again dividend income is going to be taxable under the head income from other sources. So there are some specific income which is only chargeable under the head income from other source, except the other information. Dividend income is always taxable under the head income from other sources. The term dividend as used in the Act has a wider scope and meaning than under the general law. Dividend is like normal dividend, interim dividend. We have deemed dividend concept also with us. So there's a new word that is you must be hearing first time, that is called deemed dividend. Normal dividend is like this: when company distribute profit on part of profit on earning income to the shareholder, that is called generally deemed dividend or interim dividend, etc. But that is called normal dividend. or interim dividend, etc. But deemed dividend is something else. There is no practically sharing of profit. Technically, as the dividend refers, that company distribute a part of profit to its shareholder. So now deemed dividend, just the word includes the word dividend, but the concept of distribution of profit is not like that. So we are distributing something, but not the normal profit. And that's why we are calling it deemed dividend. We are assuming these distribution equivalent to the dividend and it's going to be taxable at par as normal dividend in the hands of shareholder. So we have 5 sections regarding it, 222A, B, C, D, and E. A talks about distribution on release of company's asset. We have detailed provision underneath it. B, distribution of that item to shareholders and bonus to preference shareholder. Distribution on liquidation of company. Distribution on reduction of share capital. And last is E, loan and advances by a closely held company. We are talking about closely held. So one is a closely held company, others are widely held company. So closely held companies are just equivalent to private companies sort of. Accumulated profits, whether capitalized or not. So do not bother about section 2A, B, C, D, E. We are going to discuss each one of them with example and detailed provision. What is accumulated profit, etc. Everything is going to be discussed. Just relax and enjoy the studies. Enjoy the knowledge you are gaining. So whenever you read anything, any subject, any faculty is going to teach you, just enjoy that your brain is receiving something good. It might be that you are not interested in that, you are not might be enjoying, but you should understand it is good for you. Like junk food. Whenever you eat junk food, your taste buds feel very good, but your stomach is really feeling very bad because it's junk food. You are dumping junk things into your body. So your body is technically not responding good, but because the taste, our tongue is taking the taste, so it's feeling good, but technically it's very harmful. And when you have eating healthy foods like vegetables, etc., green vegetables, etc., might be your taste buds are not feeling good, but technically your whole body is very happy. That wow, you are taking the best thing the body was required. In the same way, when you are studying your chapters, your provisions, might be you're not feeling good, but let me tell you, your brain is very happy. Your future is very happy. So just take it, the knowledge, and enjoy that. So dividend covered by section 220A to E. According to section 222, the following receipts are deemed to be dividend. The first is distribution of accumulated profits entailing the release of company's assets. So if company distribute any of its asset to the shareholder, any of its asset to the shareholder, that will be counted as deemed dividend. So any distribution of accumulated profits. What is accumulated profit? That is reserve and surplus. Whether capitalized or not. Whether capitalized or not means if any part of reserve and surplus has been utilized to issue capital like bonus share, etc., they will still form part of accumulated profit for the purpose of section 222. So any distribution of accumulated profits, whether capitalized or not, by a company to shareholder is dividend if it entails the release of all or any part of asset. So you might learn it like this: if company distribute any of its asset to the shareholder up to accumulated profits, that is going to be your deemed dividend. You might be feeling confused regarding it. Just wait. Here we come with an example. So it's a balance sheet. You can see liabilities. We have equity share capital, including bonus share of rupees 1 lakh issued out of reserve. So in this 3 lakh, 1 lakh has been utilized from reserve and surplus to issue bonus share. That is called accumulated profit capitalized. So in this example, technically 1 lakh rupees reserve and surplus has been capitalized to issue capital. And the reserve and surplus has been given 2,20,000. After utilizing 1 lakh into the bonus share. So technically we can say the accumulated profits are not 2,20,000. They are 3,20,000. So the word was accumulated profit, whether capitalized or not. So in this example, the profit has been capitalized of rupees 1 lakh into bonus share. So for the purpose of the section 222, we will take 3,20,000 as your accumulated profit. And we have the asset side, cash and asset. Of course, company distributed assets of rupees 2,25,000 to shareholder. And the FMV are as follows of asset. So there are 4 different cases up to the amount of FMV and accumulate profit. That will be your technically deemed dividend in the hands of shareholders. So point 1 says, suppose the FMV was 1,50,000. So the concept says this. We have to find it like this. This is the formula, FMV of asset distributed. That will be given in question like this. This is question part. Or accumulated profits, whether capitalized or not, whichever is lower, is your deemed dividend. So we have an accumulated profit of 220 plus 1 lakh. So technically we have 3,20,000 accumulated profit. Now, if the FMV is 150, then we need to compare it with 320. So 320 or 150 lower will be your deemed dividend. If the FMV is 2 lakh rupees, these point number 1, 2, 3, 4 are separate example. They are not combined. So 320 or 2 lakh. This is your deemed dividend. If FMV is 3 lakh, then 320 or 3 lower is this. And if FMV is 4, then 320 is your accumulated profit. Deemed dividend cannot exceed the accumulated profit. So 4 lakh or 320, whichever is lower, 320 will be your deemed dividend. Clear? Simple. It's very simple. It's look like a balance sheet. It might be difficult, but it's very simple. Just a formula. FMV or accumulated profit, whichever is lower. Next, distribution of debenture, deposit certificates to shareholder and bonus share to preference shareholder. So if any company distribute debentures or debenture certificate to shareholder, that will count as deemed dividend. And if they issue bonus share to preference shareholder, that is also deemed dividend. But if any bonus share issued to equity share, there is no deemed dividend. Any distribution to its shareholder by a company of debentures, debenture stock or deposit certificate in any form, whether with or without interest, and any distribution of bonus share to preference shareholder, to the extent to which the company possesses accumulated profits, whether capitalized or not, will be deemed dividend. The market value of bonus share is deemed as dividend in the hands of the preference shareholder. In case of debenture stock, etc., their value is to be taken at the market rate at which, and if the rate is no market rate, they should have be valued according to accepted principle of valuation. Bonus share, I just told you, given to equity shareholder are not treated as dividend because that's a normal nature. So now we have an example again, and you can see what is the accumulated profit. In solving the deemed dividend question, first of all, you should calculate the accumulated profit. So in this example, 3 lakh is the reserve and surplus, but 50,000 has been issued out of reserve as bonus share. So technically, our accumulated reserve is 3,50,000. Now the company issued bonus share to all the shareholders in the ratio of 1:1. So equity shareholders receiving any bonus share does not form part of deemed dividend. But the preference shareholder receiving 1 lakh rupees as deemed dividend as bonus share. So bonus share allotted to equity shareholder will not amount to deemed dividend under section 222B, but bonus share allotted to preference shareholder will amount to deemed dividend. So deemed dividend is 1 lakh in this example. Okay. Distribution on liquidation, same provision. You can see the company is distributing something, distributing any asset anytime. That is section 222A, anytime. Liquidation does not necessary. The point number 2 was distribution of debentures, etc. to any shareholder or bonus share to preference shareholder. That is deemed dividend. Now we are distributing anything at the time of liquidation. They all are different, mutually exclusive case. Section A was different condition, B was different. Now C is on liquidation. Any distribution made to the shareholder of a company on its liquidation, to the extent again, to the extent to which the distribution is attributable to the accumulated profit of the company immediately before its liquidation, whether capitalized or not, is deemed to be dividend. Same provision. Distribution on reduction of capital. So any distribution to its shareholder by a company on the reduction of its capital, to the extent to which the company possessed accumulated profit, whether capitalized or not, shall be deemed to be dividend. Now you can see in this example, the reserve and surplus value is 2,25,000. It's very important to find the correct, not 225, it's of course 1 lakh rupees. Sorry, it's not 25,000, it's 1,50,000. So accumulated profit means reserve and surplus plus any reserve which has been utilized for issue of capital. So that is capitalized part of reserve and surplus minus any loss. So in this case, P&L account has been given in the debit side and the asset side. That means it's a loss. So we did not accumulate, we did not combine it with the reserve and surplus. We showed it separately. So you should understand in this example, the accumulated profit is 2 lakh plus your bonus share minus your profit and loss if given in asset side. So technically we have 1 lakh rupees accumulated surplus or accumulated capital in this example. So now on the basis of that, we will solve the question. The company reduced share capital by 1,50,000 by setting off the debit balance of P&L account. So you can see in case 1, there is no distribution of asset. Company just set off the debit balance against the share capital. So that is not a deemed dividend case because nothing has been received by shareholder as distribution of any asset. The company reduced the share capital by rupees 1,50,000 by refunding cash to the shareholder. Now, in this case, cash is also asset and that is received by the shareholder on liquidation. This will create deemed dividend in the hands of shareholder. So the share capital 150 paid as a cash, but we are accumulated profit is only 1 lakh. So lower will be your deemed dividend in case number 2. You can see 1 lakh is the deemed dividend as your accumulated profit is only 1 lakh and taxable in the hands of recipient. That was section 222A, B, C, D. The definition of accumulated profits is given over here. You can read it. It's simple. I have already explained that is share capital plus, reserve and surplus. Any reserve and surplus which has been capitalized and deduct the profit and loss or loss has been given in the asset side of the balance sheet. Now, section 222E has separate implications. So they all are deemed dividend, A, B, C, D, E. But A, B, C, D technically refers to same kind of conditions when companies distributing something in different situation to different person. But 222E still it's a part of deemed dividend family, but it has separate implication. It says any payment by a company, not being a company in which the public are substantially interested. That is a closely held company. In a company in which public are substantially interested, that is technically our widely held company, but this is our closely held company. So it's not widely held company, it's a closely held company provision only applicable on closely held company, generally private companies we can say, of any sum by way of advance or loan. So if there is a closely held company which provides loan and advances to its shareholder, who is technically holding 10% or more voting power in that company. So in that case, if any closely held company pays loan or advances to its shareholder holding 10% or more equity share capital in that company, then that loan will not be treated as his liability, not as his loan. that loan advance will be treated as his income under section 222E as deemed dividend. So if loan advance is given to a shareholder being the beneficial owner of share, beneficial owner means real owner, holding not less than 10% of the voting power, or any concern if that company is paying to loan or advances to any partnership firm. In that partnership firm, that shareholder having substantial interest, then again that is treated as a deemed dividend. So if directly it's paying to the shareholder who holding 10% or more of the voting power, or any concern in which that shareholder holding 10% or more of that company is also holding 20% or more of that concern profit, that's called substantial interest, in which such shareholder is a member or a partner and in which he has a substantial interest. That means 20% or more of the voting power or profit sharing ratio. Or any person on behalf or for the individual benefit of any such shareholder. Or if company is paying to any other person, but on behalf of that beneficial shareholder or for the benefit of that beneficial shareholder. And again, in that case, it's going to be your deemed dividend to the extent to which the company possesses accumulated profit. Do not worry. We have solved example, almost 3 or 4 example, only for section 222E. This is the provision, of course, any payment by company which the public are not substantially interested of any sum by way of advance or loan to any shareholder who is the beneficial owner of 10% or more of the equity share capital. Advance or loan by a closely held company to a specified concern. We are talking about that if that company is paying loan advances not to that person, but paying to any organization in which that person having substantial interest, then again that will be called as deemed dividend in the hands of that person. Exception, in some cases these provision will not applicable if the company's ordinary course of business is providing loan, etc. It's a normal business of that company. It's not a special situation like a bank. So banks generally provide or deal in loans paying, advance paying. So in that case, if the loan advance paid by that company, which is in it doing it's in an ordinary course of business, then in that case, that will not be a deemed dividend. Dividend paid is set off against the deemed dividend, where a loan has been treated as dividend and subsequently the company declares the dividend to all its shareholder, including borrowing shareholder, and the dividend so paid is set off by the company against the previous borrowing. The adjusted amount will not be again treated as a dividend. So the provision says that something has been assumed as deemed dividend. Some loan has been assumed as deemed dividend. And if any dividend amount has been adjusted against that loan, that it will not again treat as a deemed dividend. Subsequent repayment of loan or charge of interest at market rate does not make any difference in the applicability of section 222E. Once a loan becomes the deemed dividend, that will remain deemed dividend even if you repay it in the same previous year. We have example, so you might be more easily going to understand with the help of these examples. Read it very carefully. HUF through its Karta, Mr. Kishore. So HUF, whose Karta is Mr. Kishore, is a shareholder in the private company and holds 13% share in the company. So who is the beneficial owner? Mr. Kishore is the beneficial owner, okay, not the HUF, because the holding power of Mr. Kishore is more than 10% in that company. The company has accumulated profit of rupees 10 lakh. The company gives loan to 2 lakh rupees to Mr. Kishore in his individual capacity and loan of 3,50,000 to the HUF. So company paid loan directly to Mr. Kishore and also to the HUF. Now the provision says 3,50,000 is the deemed dividend in the hands of HUF, because HUF is the beneficial owner of the shares. So that the HUF actually holds the share in the company, not the Kishore. So in this case, the private company There's a HUF. So HUF is holding 13% share in the company via its Karta, Mr. Kishore. So Mr. Kishore is not the actual owner, not the beneficial owner. The beneficial owner is HUF. He is just the representative, because the word is, we just missed, that is through its Karta. So Mr. Kishore is just a channel by which the HUF hold the shares in the company. So who is the real owner is HUF. So any loan advance given to HUF will be deemed dividend. But if any loan advance is given to Mr. Kishore, and because he does not hold shares in his individual capacity, will not form deemed dividend in the hands of Mr. Kishore. So the answer is 3,50,000 is the deemed dividend in the HUF, because HUF is the beneficial owner of the shares. No deemed dividend in the hands of Mr. Kishore. Clear? We have a lot of syllabus need to cover today. The provisions, the MCQs, the test for your knowledge, and etc. So we are actually speeding up. Example number 2 for same section 222E. So the accumulated profit you can see in this example is again, because the profit and loss account also given in the debit side. So the technical accumulated profits, reserve and surplus 2 lakh. Then the provision says profit and loss account is 25,000. So now it's 1,75,000. The company is a closely held company and gives a loan 3 lakh to the shareholder holding 16% shares. So in that case, the accumulated profit will be 1,75,000. Mr. Rajiv holds 11% shares of Z Private Limited. The company has accumulated profits of rupees 10 lakh on 1/1/2023. Rajiv is also a partner in firm Messrs. AKR, in which his profit sharing ratio is 25%. The company gives a loan of rupees 2 lakh to Messrs. AKR and also a loan of 50,000 to Mr. Rajiv on 1st January 2023. So technically, the accumulated profit in this example is 10 lakh rupees. Mr. Rajiv hold 11% share of private limited, so he is the beneficial owner. So if anything, he will receive as loan and advances will be deemed dividend. And the firm in which Mr. Rajiv is also a partner having substantial interest. So technically, anything if that firm is also going to receive will become technically the deemed dividend. So 50,000 deemed dividend in the hand of Mr. Rajiv and 2 lakh is the deemed dividend in the firm A.K.R. because that technically Mr. Rajiv is a substantial holder in that partnership firm also. So that was our deemed dividend provision. The clarification regarding the deemed dividend, that if any company in the normal course of business receive any advances from the shareholder holding 10% or more, then again this provision of deemed dividend will not be applicable. You can read it, it's very simple. Now dividends are like deemed dividends, dividend declared, normal dividend, we have deemed dividend section 222E also. So we have deemed dividend section 222A, B, C, D, and we have deemed dividend section 222E also. And we have interim dividend. They all are going to be charged in the hands of shareholder under income from other sources as normal rate of tax. Tax rate on dividend income, any income by way of dividend received by a resident from a company, whether domestic or foreign, is taxable in the hands of resident shareholder at normal rates of tax. We have example also, and it says Rahul, a resident holding 28% of equity shares in a company, took a loan of 5 lakh from the same company. On the date of granting the loan, the company had accumulated profit of 4 lakh. The company is engaged in some manufacturing activity. So, first points asked, is the amount of loan taxable as deemed dividend? Mr. Rahul has a beneficial owner of 10% or more in the company. He received loan also. So till now we can say that yes, it can be deemed dividend, but It says if the company is a company in which the public are substantially interested, the provision of deemed dividend is applicable in section 222E only if the company is a closely held company in which public are not substantially interested. But point one say, if it is a company in which public are substantially interested, what will happen? The answer will be no. There will be no deemed dividend in the hands of Mr. Rahul. The loan will be treated as loan in the hands of Mr. Rahul. But point number two say, what would be up to the accumulated profit? That loan will be deemed dividend in the hands of Mr. Rahul. So accumulated profit is 4 lakh, loan is 5. So 4 lakh will be deemed dividend in the hands of Mr. Rahul. That is a solution. You can read it. Very simple. Now a very interesting provision come, and that is casual income. Casual income is a very interesting income because it depends upon the destiny in comparative to your hard work or your labor. The majority part is playing by the destiny. So any income which is technically earned by you casually is based upon your luck. That is called casual income. Like winning from lotteries, game shows, betting, etc. They all are technically casual income because up to a certain level, your hard work is there. Your knowledge might be there up to a certain level, but your destiny plays a specific role. Like for KBC, if somebody winning any amount, then you might think any prize money, then you might think that is not a casual income because somebody has won that amount with his knowledge or her knowledge. But no, it's technically a casual income. Because the question they asked, it's your destiny that you got the answer. Because if the knowledge base, if the winning is knowledge based, then might be a person who is very qualified, educated, should win higher amount than those person who are not that qualified in that game show. But you might have seen that most of the knowledgeable people might not getting that much amount. What a simple, normal, educated, or maybe illiterate person was won in that game show. So the destiny is that those questions asked to you for which you already know the answers. So that is the destiny. You know the answer, you gave the answer, that is might be your knowledge also, but the majority part that those question has been asked, the answer is actually you remember. So that is technically a casual income. So any casual income, betting, winning from lottery, etc., game shows, they all are casual incomes. So play games and win real cash. And we have some specific characteristic also. You can see point one say tax at 30% fixed. Casual incomes are going to be taxable 30% fixed. No basic exemption, nothing. So if somebody has won 1 crore rupees from KBC, that means 30% tax, at least minimum 30 lakh is going to be as income tax and surcharge again and education cess also. That is 30% fixed, no basic exemption, no deduction, etc. So no deduction of expenses. If you say I went to play the KBC from my city, Delhi to Mumbai, and there was expenses for traveling, staying, etc., that should be deducted. No deduction of any expenses. This is going to be tax fixed. No deduction on section 80C to 80U, chapter 6 deduction also not available, and no basic exemption apply. No basic exemption also applicable. So you cannot deduct anything from your winning amount out of your casual income. So casual income means income in the nature of winning from lotteries, crossword puzzles, race, including horse race, card game, and other games of any sport, gambling, betting, etc. Such winning are chargeable to tax at a flat rate of 30% under section 115BB, and tax is deducted at source 30% on such income if it exceeds 10,000. So tax is deducted is all about TDS. That is going to be discussed with you under chapter number 9. Point number 3 is a different section, it's a new section, and it says if there is a private company, there is a private company, or it says closely held company. So if there's a closely held company and it's issued shares at premium, That means higher than its face value, at least face value at premium. And if the issue price exceed the FMV of share, the difference will be income from other source for that company, not the shareholder, he is the buyer. So if there's a private company, or we can say closely held company, and if it issue its share at premium and the issue price exceeding the FMV, then the difference will be income from other source in the hands of that company. Very simple provision, but very important for the purpose of examination. Of course, section 56 to 7B brings to tax the consideration received from a resident person by a company other than a company in which public are substantially interested, which is in excess of the FM. Such excess to be treated as income from other sources if the issue price exceed the face value. The fair market value will be decided as per the according the prescribed method, etc. Moving on to the example directly, it's very simple. You can see number of shares is 10,000, A private limited, face value is 100, FMV is 120, issue price is 130. So you can see the shares are issuing at premium and the face value was 100, FMV was 120, but the issue price is 130. So if anything is excess of FMV, that is going to be taxable as your income from other source. So in this example, 130 minus 120, 10 rupees per share is going to be taxable in the hands of a company. That means 1 lakh rupees is income from other source in the hands of company. First example, clear? It's too simple. It's just a mathematics, nothing, just a single formula. If FMV is less than the issue price, or we can say if issue price more than FMV, the difference is going to be taxable. Next example, we can see that 20,000, 10 rupees face value, FMV is 120, and issue price is 10. 110. So now you can see the issue price is less than FMV. So if issue price is less than FMV, this provision will not be applicable. No income from other source in the hands of a company. Now the face value 100, FMV is 90, and issue price is 98. So these shares are not issuing at premium. Technically, they are issuing a discount because it is less than the face value of the shares. So again, in this case, there is no concept of taxability is applicable in income from other source. Last example, it says the face value is 100, FMV is 90, and the issue price is 110. Now, the issue price is at premium, FMV was 90. So the difference between the issue price and the FMV, that means 20 rupees per share, is going to be taxable as income from other sources in the hands of the private limited. These are very simple question, of course. Income from other sources are, I guess, comparative to other chapters is technically easy because it do not have any format. They have separate small provision, and again these small provisions are really easy to understand. Nothing is complicated except the provision of gifts, which is just going to we are going to read in few minutes. So point number 4, of course, it's the old provision, interest received on compensation or enhanced compensation. We have discussed that in case of enhanced compensation, if we receive interest, that is going to be taxable under income from other source, and 50% is going to be taxable in the year in which it is received. We have already discussed this provision under capital gain topic under section 45(5), that is a compulsory acquisition of any capital asset. Clear? Point number 5, that also we have discussed under section 51 of capital gain. If any advance money is forfeited, then the amount forfeited will be taxable as income from other source in the year in which it is forfeited. So we are not going to discuss it again. Now the main provision of income from other sources here. This is the main provision, I must say, Because any other provision we discuss, whether it's casual income, dividend, deemed dividend, or shares of FMV, etc. cases, they are very, very, very easy. This is also easy. Nothing is difficult. But that is a, we can say, lengthy in comparison to other provision of income from other sources. Other provisions are very small. This is a lengthy provision, but still it is simple. And we are talking about the gifts, etc. So let me take some queries. If there is any query, then we will move on to our this topic. Piyush Kuran is asking, in the section 112, it is mentioned that concessional rate of 10% is applicable only in case of listed share and zero coupon bonds. According to indexation topic, no indexation concept is applicable in case of debentures and bonds. Then how to calculate tax for zero coupon bonds under concessional concept? You just need to calculate tax with no indexation concept. You need not to apply indexation concept in case of zero coupon bonds. In that case, there will be no lower case of 20% or 10%. Whatever will come as per 10% provision, that will be your tax liability. Okay. So it's a provision made for that, the concessional rate provision. But because we cannot apply indexation on zero coupon bonds, so we will solve it only with the help of 10% provision. Okay. Kavita Lamsal is asking, is one session enough for this side? Yes, I guess, of course, it is enough. Because the main provision, you can see it's like 7:52 a.m. Not even 1 hour has been completed. And we have almost discussed all the basic concepts of income from other sources. The main concept is the gift provision. Then there are just questions, and test your knowledge questions. So it will be enough. The Board of Study and Institute, of course, they have a lot of knowledge regarding the topics and the session that must be allotted to the students. So they have enough sessions has been given for income from other source. I also took sessions for, I guess, capital gain in 2021. And at that time, there was only 3 sessions for capital gain topic. And I personally felt it was really, really very difficult to cover capital gain in only 3 sessions. So at that time, it was very, very difficult for me to cover all the topic. But you can see Board of Studies has actually understood that thing, and they just increase the session of capital gain to 5 sessions. So this time it was really easy for me to make you understand the capital gain with the help of examples for almost all the section. So of course, 1 session is enough. Do not worry, we have enough time. Okay, next is Vaishali. Example 2, what is Darshan is asking something regarding example 2. Okay, we'll take that time. What about the capitalized reserve? This should not be P&L account. It's technically cash, other asset. The notes I uploaded, kindly change that also over there. Fine. Sorry. This is correct. This was not there. It is by mistake. In this example, there is no bonus share. In the example I have uploaded, kindly change this question, of course. Good observation. I also updated my notes. Okay, well done. Now it's clear. Vaishali and Darshan query has been solved. Okay. So moving on to our provision regarding the gifts. The concept says if you receive gifts in monetary form or non-monetary form, that is going to be taxable in the hands of recipient. So in monetary form, if you received any gift, that is going to be taxable. And in case of non-monetary form, if you're receiving any gift, that is also going to be taxable. But in case of non-monetary, we have 9 only assets. We have only 9 assets that is going to be treated as your income in the hands of the recipient. if you are receiving any property other than these 9 properties, non-monetary, that is still exempt in the hands of receiver from the taxability under income from other source. So in non-monetary, you can see A point is saying immovable properties, land, building, or both. And B is having movable specified asset, which have 8 specified assets. So in non-monetary category, there are total 9. One is land and building, that is immovable property, and the 8 movable property which has been specified. So except these 8 specified assets, if you are receiving any other movable property, that is outside the purview of taxability. So this is the details of asset. Those are included. These are non-monetary assets which are includable under income from other source. So you can see at the left-hand side, there are movable assets, and that is immovable asset. In movable, there are shares and security. Those are other than monetary. Jewelry, archaeological collections, drawings, paintings, sculptures, any work of art or bullion. Any other asset except above is outside the purview of income from other source if given WC or IC. WC is without consideration. IC stands for inadequate consideration. So other than these assets, if any other asset has been received, that is not going to be taxed. Just a second. Excuse me. Okay. So one by one, we will read the provision regarding this. First of all, it says regarding the monetary provision, if any sum of money or value of property received without consideration or for inadequate consideration to be subjected to tax in the hands of the recipient. This is the basic of this section that we are talking about the monetary or non-monetary asset. Any sum of money denotes monetary or value of property. Property means non-monetary item. In order to prevent the practice of receiving sum of money or the property without consideration or for inadequate consideration, Section 56(2)(10) brings to tax any sum of money or the value of any property received by any person without consideration, in short, WC, or the value of any property received for inadequate consideration, that is IC. First is sum of money. If any sum of money is received without consideration and the aggregate value of such exceed 50,000, the whole of the aggregate value of such sum is charged to tax. So if Mr. A receiving any amount of money from any person and the aggregate of that person, if it exceeds 50,000, then the whole amount is going to be taxable as your income from other source. For example, if there is Mr. A who pays 26,000 without consideration as a gift to Mr. B. There is Mr. C who also paid 27,000 in that previous year to Mr. B in cash without consideration. So in this case, Mr. B aggregate cash or monetary value received in this previous year was 53,000. So that is going to be taxable as income from other source in the hands of Mr. D. So the whole amount will be, and which is aggregate. That means whether received from single person or in aggregate. But if the monetary value without consideration received by assessee in the previous year exceeding 50,000, the whole amount is going to be taxable in the hand of that recipient under income from other source. I hope it's clear. Moving on to now monetary provision. So I was saying that this provision is the only important or lengthy provision, but you can see the monetary provision is so simple. It's very, very, very easy. Now the everything which is you can say difficult or comparatively difficult with the other provision of this section, this chapter is non-monetary items. So now immovable property under non-monetary, I told you there is two kind of properties has been included. So if we say that is gift provision we are talking, that is monetary, we just understood the provision if without consideration more than 50,000 in previous year from one or more person, then whole amount income from other source. Now in case of non-monetary, we have land and building and other 8 specified assets. And in both, there are two concepts: without consideration, inadequate consideration. Without consideration, inadequate consideration. So we are going to discuss now these provisions. After this provision, this chapter is almost done with the basic or more important provision. Few just provision will be left. Otherwise, the conceptual, the important part of this whole chapter, you can say, we will cover after provision regarding the non-monetary asset. Clear? So if an immobile property is received without consideration, and if the stamp duty value, it says if the stamp duty value exceeding 50,000, the whole amount will be income from other source. So it's again, this part is very easy. The stamp duty value of such property would be taxed as income from other source if to the recipient if it exceeds rupees 50,000. Very small amount. Of course, almost all the immovable property generally must be a value exceeding having 50,000 rupees. Now for inadequate consideration, there is special provision which I am going to teach you with the help of a detailed concept. So for inadequate consideration in case of land and building, the provision says, or we can say like this, monetary provision we discussed. In previous year, without consideration, whole amount income from other sources. Clear? Now the other part is non-monetary. In this non-monetary, there is two asset, that is land and building. Others 8 specified. For land and building, the concept says either it's going to be received without consideration or inadequate consideration. So if it's without consideration and the stamp duty value exceeding 50,000, the whole amount income from other source. Sorted? Clear? Done? Now the second say, if it is inadequate consideration, and if consideration is less than stamp duty value, and the difference is more than higher or following. It says, in case of immovable property, if it is received inadequate consideration, then the provision says if the consideration is less than stamp duty value, or we can say the stamp duty value is more than consideration, same thing, then we have to find these two values, that is 50,000 is fixed, higher of the following, or 10% of consideration, whichever is higher. So now the difference between stamp duty value and consideration, the difference between stamp duty value and consideration must exceed this higher value. If it exceed, if the difference, if exceed this higher value, then this difference is income from other source. Let me give you example. That's why you then you will be able to understand this provision very easily. For example, if the stamp duty value in question is 10 lakh and 60,000 and the consideration value is 10 lakh. So provision will apply because the stamp duty value exceed the consideration. So the provision will be applicable. Income from other source. The difference is 60,000. Now this difference should exceed. Now the difference should exceed the higher of these two values, what we are going to calculate. The provision applicability started because stamp duty value is more than the consideration. So if stamp duty value is more than consideration, find out the difference. First point, if it exceed. Second, now find the difference between it. That is 60,000. Now the third case says calculate two values. First is fixed 50,000. Second is 10% of consideration. And that 10% of consideration will be 1 lakh. Find the higher of it. Higher is 1 lakh. So the difference should exceed. Difference should exceed this higher. In this example, difference is only 60,000. And this higher value is 1 lakh. So difference does not exceed the higher value of calculation. So in that case, there is no income from other source taxability. Understood? Now let me take the example number 2. Suppose the stamp duty value is 12 lakh. The consideration is 10 lakh. So because stamp duty value exceed the consideration, the concept is applicable. Point number 1. Now the difference between the stamp duty value and consideration is 2 lakh. Now we will find this two values. That is 50,000 is fixed and 10% of consideration, which comes to 1 lakh. Whichever is higher is, of course, 1 lakh. Now my difference should exceed, and you can see, yes, it is exceeding the difference. The difference should exceed this higher value. So difference exceed the higher value. And if it is so, now income from other source will be the difference. 2 lakh becomes the income from other source in the hands of the recipient. So there is 3 steps you need to understand. First of all, stamp duty value should exceed the consideration. Then you need to find the difference between these two. Then apply the higher concept. 50,000 is fixed and 10% of consideration you need to find out. The higher value. Now the higher value, whatever we find out. So now the stamp duty value should be higher that should exceed the higher value. The stamp, if it is so, then the difference is going to be taxable as your income from other source. It's little complicated, but with the help of example, I personally feel it will be easy for you. Yes, glitch, internet. Okay, it's fine now. Okay. So this was the concept regarding the inadequate consideration for land and building concept. I hope it's clear. But there is an amendment also. And it says that concept is applicable. If this concept is applicable for residential unit, if you are receiving a residential unit, from the person who is holding it as a stock in trade, and it's transferring you as a capital asset. So if the seller transferring a residential building, if it is a stock in trade in his hand, and he is transferring this you for inadequate consideration, and for you it's not a stock in trade, for you it's a capital asset. In that case, the same concept will applicable, but the percentage what we were 10% of consideration. For the purpose of comparison, we were taking 10%. That will change to 20%. So it says if this property is a residential property and the seller, the person who is transferring this property, was holding it as a stock in trade, and the buyer who is the receiver is receiving it as a capital asset. So seller's stock in trade, if a residential property which is transferring to the buyer with inadequate consideration, in that situation, in the case of this 10%, this limit will be replaced by 20% if we fulfill certain more conditions. So what are the conditions? Let's switch to that conditions. So this was the provision what we are just discussed. With the help of that diagram, we are going to read it. For inadequate consideration, if consideration is less than the stamp duty value, or we can say the stamp duty value is higher than that, and the difference between the stamp duty value and the consideration is more than the higher of the same concept we discussed. The difference, if the difference is higher than these two values, then the difference between the stamp duty value and the consideration shall be chargeable to as tax. Clear? As income from other source. In case immovable property, now the provision what we were discussing, that in case of residential unit, the percentage of 10% will be replaced by 20%. In case of immovable property being a residential unit, fulfilling the stipulated condition mentioned below is received for inadequate consideration from a person who holds such property as stock in trade. Then only if the stamp duty value of the residential unit exceed the sale consideration by 20%. We just need to change one thing, 20% in place of 10%. 50,000, whichever is the same concept, same provision. You just need to understand that specific conditions are three. The residential unit is transferred during the period from 12th November 2020 and 30th June 21. Such transfer is the way of first time allotment of the residential unit, and the consideration paid or payable as a result of such transfer less than or equal to 2 crores. These three conditions should be fulfilled to apply 20% in place of 10%. Value to be considered where the date of agreement is different from the date of registration. We always take stamp duty value at the time of transfer. But as we discussed in section 43CA of PGBP head and section 50C, we can also take the stamp duty value at the time of registered agreement if certain conditions are fulfilled. That the payment should be via check, etc. All these conditions, what we have discussed in section 50C and 43CA, again repeated over here. Kindly read this point number 2. If the stamp duty value of a property is disputed by SSE, then the valuation officer will decide the value. If there is any dispute regarding a stamp duty value, then the valuation officer should be notified by the government, and the value decided by him will be the value. Now the same provision for inadequate consideration or without consideration is applicable for other movable asset. And again, it's very simple. For the purpose of income from other sources, I am not going to upload any chart because this is very simple topic. And the chart I am just preparing over here, you can use it. You can write down with your handwriting and you can use it for the purpose of examination. Okay. So for other asset, I am stretching it over here for other. Other 8 specified assets, same concept applicable without consideration. But for other immovable, there's no stamp duty value. It can be only for immovable property. So stamp duty value will be replaced by fair market value. If it exceeding 50,000, whole value will be income from other source. If inadequate consideration, then difference between FMV and consideration will be find out for each asset separately. Each asset separately, and if these difference in aggregate exceeding 50,000, then full value will be income from other source. For example, I received one asset like jewelry and the difference was 30,000. Difference is 30,000. So not going to taxable. I also received one more asset from some other person in the same previous year, like shares. The difference was 40,000. So individually, they do not exceed 50,000 limit, but in aggregate, in the end of the previous year, if you will say this is now 70,000 non-monetary gifts I have received inadequate consideration, the difference is exceeding 50,000. So now in this case, 70,000 will be income from other sources. So for non-monetary asset, in case of inadequate consideration, you need to take the differences for you and the aggregate of difference. If it exceeds rupees 50,000, then in that case, that is going to be taxable. Here are the provision. The aggregate fair market value, if the without consideration case, going to be taxable. For inadequate consideration, if the difference between the aggregate fair market value and such consideration exceed 50,000, such difference would be taxed as the income of the recipient. Applicability of section 56(2)(10). The provision of section 56(2)(10) would apply only to property which is in the nature of capital asset of the recipient. So if you are receiving any capital asset, if you are receiving any asset, but it should be your capital asset. For example, if somebody is transferring you his asset and that is your stock in trade, then this provision will not be applicable. So if the recipient receiving any capital asset as a gift without consideration or inadequate consideration, and if for the purpose of recipient, if it is a capital asset for him or her, then this provision will be applicable. So this provision says, read it very carefully. The provision of section 56(2) would apply only to property which is in the nature of capital asset of the recipient and not stock in trade, raw material or consumable stores of any business of the recipient. Therefore, only transfer of a capital asset without consideration or for inadequate consideration would attract the provision of section 56(2)(10). If it is your stock in trade, then it will fall under PGBP provision, not under income from other source. So this is summarized by the institute in their study materials. It's a very good summary. You can read it, the provision, with the help of this. It will really help you, of course. Non-applicability of section 56(2)(10). That means the gifts will not be taxable. They will remain exempted if these conditions fulfill. So these are technically the exception in case of gift provision, whether monetary, non-monetary, etc., any kind of gift. However, any sum of money or value of property received in the following circumstances would be outside the ambit of section 56(2)(10). If the gift is received from any relative on the occasion of the marriage of the individual, that means assessee, under a will or by way of inheritance, in contemplation of death of the payer or donor, from any local authority, from any fund or foundation or a university or other educational institution or hospital or other medical institution or any trust, from or by any trust or institution registered or by any fund or trust or institution or any university, other educational institution or medical or hospital institution, By way of transaction not regarded as transfer under section 47, you might be remembered section 47 under capital gain provision. In this case, they will not regard as transfers. So in the case, all these cases, this provision will not apply. From an individual by a trust created or established solely for the benefit of relative of the individual, from such class of person and subject to such condition as may be specified. The new amendment that is important for your examination, it's very, very important. Please kindly read this. By an individual, if any gift is issued by an individual from any person in respect of any expenditure actually incurred by him on his medical treatment or treatment of any member of his family for any illness related to COVID-19. We are talking about the COVID-19. The COVID-19 you all know, of course. So if any amount is received for that pandemic, COVID-19 medical treatment for himself or family member, in that case, that will not be treated as gift, not going to be taxable, subject to conditions notified by government. By a member of the family of a deceased person. If somebody died in a family and due to COVID-19, and in that case, if the amount has been received from the employer of the deceased person without any limit, that is not going to be taxable from any other person or person to the extent that such sum or aggregate of such sum up to 10 lakh rupees. So if received by employer for the deceased of any person, then in that case, there is no monetary limit. And if received by any other person, then in aggregate, it should not exceed 10 lakh rupees. Up to 10 lakh rupees is exempted. Where the cause of the death of such person is illness related to COVID-19, the payment is received within 12 months from the date of death of such person and subject to other condition as the central government may notify. Meaning of certain term. Now we are discussing the meaning of property. Those are included for the purpose of income from other source. We have already discussed these point in the picture I have shown you. Assets means immovable property, and these 8 assets are over here except this: shares in security, jewelry, archaeological collection, drawing, painting, etc. Relative definition is over here. Kindly read this, of course. In case of Hindu undivided family, any member thereof will be treated as relative. Family definition also given. This is a diagram which is in your study material, designed by the Course Institute. It's a beautiful diagram, wonderful to make you understand the provision very easily. In this diagram, there is TDS provisions also mentioned in some places. So these TDS provision you can skip now. That you will be able to understand when you will be reading chapter number 9, that is advanced tax, TDS, etc. Fine. Moving on to our illustration part. Before that, let me see if there is any query regarding it. Bullion, somebody is asking, Vaishali is asking bullion. I personally feel bullion word you must have read earlier also. I guess in chapter number 1, that is basic concept of income tax. There is like black money concept section, those related with black money, section 69A, B, C, D. There's also a point which says if there's any unexplained money, bullion, or jewelry. The heading says this: unexplained money, bullion, and jewelry. Even in capital gain, when we reading the definition of capital asset, there is also personal gift, etc. The exception also include the bullion, the jewelry, etc. But the bullion meaning I can explain you that unformulated solid precious metal, we can say solid. Like if you have gold and you convert it into a necklace or a ring or a bangles, these are called jewelry. But you have gold biscuits in unformulated form, in a solid form, gold bars, gold brick, etc. They are called bullion. So bullion, we can say those precious metal, not in the form of jewelry. I hope it's clear. Abhay is asking, okay, Vaishali is asking something also. Sir, if individual gets 5 lakh as a loan without interest or from relative and pay back after 1 or 2 years, then it's casual income? No. If something is loan, that is your liability. That cannot be treated as your casual income. Because you're saying it has been paid back. So if it is in paid back, then it cannot be casual income. How it can be a casual income? Abhay is asking, generally stamp duty is being paid on purchase, then how it can be income? We are not saying about stamp duty, Abhay, you might be getting it wrong. We are talking about stamp duty value. When we transfer any immovable property, there is a thing that is called consideration, and there is a call which says government value. For example, I bought a land or I sold a land. So that is a value fixed by government also. I bought a property, I bought a building for 80 lakh rupees. That is the consideration I paid for buying it. But government also decide a value as per government norms, might be 70 lakh. So I can pay higher than that, but that government value we are talking, we are not talking about stamp duty, we are talking about stamp duty value. Okay. Illustration number 2. So Mr. A, a dealer in share. Very important illustration. So Mr. A, dealer in shares received the following without consideration. I need to open this question in my another device so I can read it over there and solve it separately. Just a second. Page number. Illustration number is okay, yeah, fine. So we are going to solve illustration number 2 on a separate sheet, so you would be understand what I am doing. So illustration number 2, information I am writing for you. Mr. A dealer in share. So that means shares are his stock in trade. Clear? Received the following without consideration during the previous year 22-23 from his friend. Let me give you a trick to solve this question also. If there is income from other source, gift provision concept is there. So you can draw a simple diagram for it. As I draw for the purpose of your chart presentation, you can write it over here monetary. You can write it over here non-monetary. In non-monetary, there is land and building. You can separate that. Others. For land and building, there is concept of without consideration, inadequate consideration, without consideration, inadequate consideration. Now you just need to put the values and you will find the answer. It's very simple. So question say, he is receiving a cash gift of 75,000 on his anniversary. He's receiving the cash gift on his anniversary. So it is a monetary payment. If you receive gifts on marriage, that is exempted. And marriage and anniversary is different things. So that is going to be first point is 75,000. Clear? We are not saying it's taxable or not. We will do it after putting all the values over there. Then second is bullion, the fair market value of which was 60,000 on his birthday, 19th June 2022. So he received bullion. Point number 2, that is no money has been paid. So that is inadequate consideration, 60,000 value. Clear? Now a plot of land at Faridabad on 1st July 22, the stamp value of which is 5 lakh on that date. Mr. B had purchased the land in April 2009. So Mr. B, he is Mr. A who is receiving everything, and Mr. B is paying in everything. Mr. B, monetary payment, this and the land, all is paying by Mr. B. So Mr. B had purchased in April 2009. This is none of our concern. Fine. So now the 5 lakh plot has been received by him free of cost. That is a without consideration case. Now, other consideration, it says other informations are Mr. A purchased, we are talking about Mr. A, he purchased from his friend Mr. C. He purchased from Mr. C, who is also a dealer in shares. So Mr. C provides some shares to Mr. A. His stock in trade was also shares. And the Mr. A also stock in trade is shares. So now the other information says there's Mr. C deals in shares, provide 1000 shares to Mr. A for rupees 400. For rupees 400, but the fair market value was 600. So technically, consideration was 400, but the FMV was 600. So inadequate consideration 200 rupees each share. That means total value share he received 2 lakh rupees. Mr. A received inadequate consideration, or you can say free shares worth rupees 2 lakh. But the problem is this. This will not fall under income from other source. Why? Because we just read before that in the hands of recipient, the asset should be as a capital asset, not as a stock in trade. Because Mr. A is dealing in shares, so technically receiving shares, and that is his stock in trade, so income from other source provision will not apply. This is applicable under PGBP head. Under PGBP, his purchase will be treated as 4 lakh rupees. So for the purpose of income from other source, this information is irrelevant. Clear? Next, further on 1st November 2022, Mr. A took a possession of property, that is office building, booked by him 2 years back at 20 lakh rupees. The stamp duty value of the property as on 1st November is 2022. On 1st November 2022 is 32 lakh rupees stamp duty value. And on the date of booking, at the time of booking, he paid 23 lakh rupees. And it is out of this 23 lakh, 1 lakh paid by check. So that means because the time of booking, he paid something via check. So stamp duty value of 23 lakh will be taken for the purpose of solution. Clear? This is the provision we have already read in section 43CA and 50C also. That if at the time of agreement, the amount has been paid via check, then the stamp duty value at the time of agreement will be taken for the purpose of every provision under income tax. 1 lakh account pay check, and that property he has received for 20 lakhs. So now 20 lakh property has been received by him for inadequate consideration. So the provision says you can see the stamp duty value exceeding the consideration. Stamp duty value is 23 and the consideration is 20 lakh. So we need to apply that provision, 50,000, or it's office building, not residential unit. So we'll take 10% of consideration, which is 2 lakh, whichever is higher. So higher is 2 lakh. So the difference between the consideration and stamp duty value should exceed this higher value. Difference is 3 lakh, 2 lakh is the higher value. So the difference exceed the higher value. So income from other source will be the difference value. This 3 lakh will be your value for this case. Clear? Next, the point says, on 1st March 23, he sold the plot of land at Faridabad. So that is capital gain provision. He received the flat at 5 lakh rupees, sold it for 7 lakhs. So 2 lakh will be short-term capital gain in the end of Mr. A. But income from other source provision, now we can see exceeding 50,000, this is going to be taxable. Exceeding 50,000, going to be taxable. Exceeding 50,000, going to be taxable. Exceeding 50,000, going to be taxable. So these 4 points is going to be taxable as income from other source. We have the solution also in the study material notes. We can see it over here. You can see the whole question is there. Cash gift taxable 75,000, bullion is taxable 60,000, 5 lakh rupees, plot of land is taxable 5 lakh rupees. And then the difference between the inadequate consideration, that 23 lakh value, that is 3 lakh rupees, that is going to be taxable. The stock in trade, the shares received as stock in trade is having no treatment under income from other source, because Mr. A already transferred the same asset he got for 5 lakh rupees in the same year. There will be short-term cap gain of 2 lakh rupees. You can go through it. You will able to understand it very, very easily. So now we can move for the tea break. But before that, let me see if there's any query regarding anything. No query there yet. Somebody also asked me a question regarding section 45(5)(a). In the last session, I've solved it for him. So if he is here, he can ask me. I'll answer your question, because if you are not here, then other students might not know the provision what we are discussing. So if you want to know the answer, kindly let me know on the query. I will solve that for you after the break. Okay. So we are moving for a tea break, sir. Can we go for a break? Welcome back, everyone. So, as I always say, I believe you must have your tea, coffee, etc., and you are ready to listen the small story, and then we will move over to our provisions left. Not much provisions has been left in income from other source now because the main provision was that gift concept, the share concept, etc., and it has been covered by us, of course. Test your knowledge, etc. Only 4 questions in your test your knowledge. So we will cover it, of course, within specific time frame. For that, a small story for you, and I hope you like it. तो हुआ क्या, एक एक्सपेरिमेंट किया गया. कुछ साइंटिस्ट थे, वो ये चेक करना चाहते थे कि क्या हम लोग या क्या लोगों का ब्रेन उन्हें चीजें समझाता है, दिखाता है, और कई बार हम अपने ब्रेन की वजह से कुछ एफर्ट्स करना बंद कर देते हैं जबकि वो चीजें हो सकती हैं. तो एक एक्सपेरिमेंट ये किया गया, एक बड़ा सा वाटर टैंक लिया गया. उस टैंक के एक पार्ट में शार्क्स फिशेस को छोड़ा गया और दूसरे पार्ट में छोटी फिशेस को छोड़ा गया. तो शार्क्स ने छोटी फिशेस को खा लिया एक दिन. नेक्स्ट डे ऑफकोर्स यही किया गया. थर्ड डे से उस बड़े टैंक में बीच में एक ग्लास का पार्टीशन लगाया गया, विच वाज वेरी 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 स्मॉल. सो शार्क्स ने थर्ड डे भी ट्राई किया कि हम अटैक करते हैं स्मॉल फिशेस पे, बट वो जो ग्लास डोर था उससे टकराकर वापस आ गए. उन्हें चोट भी लगी. सो वो ट्राई कर रही थी, बहुत बार ट्राई किया, बट वो क्रॉस नहीं कर पा रहे थे, ऑफकोर्स, बिकॉज देयर वाज अ टेक्निकली पार्टीशन बिटवीन दैट. नेक्स्ट डे भी हुआ, 3 दिन 4 दिन, एवरी डे शार्क्स वर ट्राइंग कि हम इसको तोड़ दें या हम इसको क्रॉस कर सकते हैं. एंड अगेन अगेन सेम थिंग हैपनिंग कि वो नहीं हो पा रहा. तो स्मॉल फिशेस एक पार्ट पे थी, शार्क्स इधर. 10 दिन 20 दिन, 1 महीना 2 महीने तक ट्राई करा शार्क ने, और फिर साइंटिस्ट ने नोटिस करा कि उन्होंने उधर ट्राई करना बंद कर दिया. नाउ दे आर नॉट ट्राइंग, दे स्टॉप ट्राइंग. वो उधर तोड़ने के लिए जाते ही नहीं. तो कुछ दिनों बाद उन्होंने पार्टीशन को रिमूव कर दिया और ये नोटिस किया कि अभी भी शार्क अटैक करने नहीं जा रहे, बिकॉज उनके ब्रेन में एक वॉल बन गई, इट्स कॉल्ड वॉल इन द ब्रेन, कि वहां पर एक पार्टीशन है, इफ वी ट्राई तो हमें चोट लग जाएगी. जबकि वहां टेक्निकली कोई पार्टीशन नहीं था उसमें, बट स्टिल दे वोंट ट्राई. सो टेक्निकली कई बार ऐसा होता है कि हम लोग अपना ट्राई करना छोड़ देते हैं, सिर्फ ये सोचकर कि ये हमसे नहीं हो सकता, अब ये होगा ही नहीं, ये हमारी कैपेबिलिटी के बाहर है. प्लीज ऐसा कभी मत करें, वेदर इट्स योर पर्सनल लाइफ, वेदर इट्स योर प्रोफेशनल लाइफ, योर स्टूडेंट लाइफ. तो आप अपने कभी भी किसी सब्जेक्ट को आपको लगता है कि हम इसमें क्लियर नहीं हो पा रहे, तो हम इसे ट्राई करना छोड़ दें, बिकॉज हमारी कैपेसिटी के बाहर है. ये इम्पॉसिबल है. नथिंग इज आउट ऑफ योर कैपेसिटी, बिकॉज हमारी जो ब्रेन कैपेसिटी आई हैव टोल्ड यू वो इमेंस है, उसे आप मेजर भी नहीं कर सकते, इतनी ज्यादा. So you have to try with your best effort every time, and believe me, you will be successful later also. So कभी कभी लोगों की वजह से लोग हमसे कहते हैं कि आप ये नहीं कर सकते, आपसे ये नहीं होगा, तुमसे ये नहीं कर सकते, तुम ये पढ़ाई नहीं कर सकते, तुम ये अचीव नहीं कर सकते. तो अगर आपको बिलीव है कि ये हो सकता है, मुझे तो है, बिल्कुल हो सकता है, आप लोग सब कर सकते हो, सब सीए बन सकते हो. आपको अपने पे बिलीव रखना है, अपना बेस्ट एफर्ट देते रहना है, एंड डेफिनेटली जो भी लाइफ का गोल है ना, अगर वो पूरे हार्डवर्क से, पेशेंस से, डेडिकेशन और सेक्रीफाइस से किया जाता है, तो ऐसा है नहीं कि वो अचीव ना हो सकता. कुछ भी अचीव हो सकता है, कुछ भी, एनीथिंग. बट हमें ये 4 चीजें करनी ही करनी. पेशेंस रखना है, हार्डवर्क होना चाहिए, फोकस होना चाहिए, डेडिकेशन, सेक्रीफाइस तो आपको करने ही करने. और अगर आप ये सब करने को तैयार हैं तो डेफिनेटली कितनी भी मुश्किलें आए, कितने भी बीच में स्पीड ब्रेकर आए, अप्स एंड डाउन्स आए, कितनी बार भी आपको लग नहीं. अब एक कोटेशन मैं आपको अपनी सुनाता. इतने लेक्चर से मैं आपको दूसरों की कोटेशन दिखाता था, आज मैं आपको अपनी कोटेशन सुनाता. एंड दिस इज बाय मी. ये मैंने जुलाई 2021 में जब हमारा पहला बैच था वर्चुअल का, वहां स्टूडेंट्स को सुनाया था. उससे पहले मैंने किसी को नहीं सुना, किसी को भी. मतलब मेरी लाइव क्लासेस भी थे जब मैं फेस टू फेस पढ़ाता था, तो लाइक 2003 से 2020 तक, लाइक 17-8 ईयर्स. तब भी मैंने किसी बैच में नहीं बताई, मैंने अपने किसी दोस्त से शेयर नहीं करी थी, इवन नॉट विद माय पेरेंट्स आल्सो. मुझे लगा कि शायद वो प्लेटफॉर्म सही टाइमिंग नहीं थी, एंड जब वर्चुअल क्लास स्टार्ट हुई तब मैंने वो फर्स्ट टाइम शेयर किया। और ये वो लाइंस हैं जो मैं अपने पढ़ाई के दिनों में खुद से कहता, मैंने खुद से के लिए बनाई थी, कि जब भी ऐसा मुझे लगता था कि अब ये नहीं हो सकता, पढ़ाई बहुत डिफिकल्ट है, मुझे लगता था कि दिस इज इनफ, मेरे बस का नहीं होगा, तो मैं ये लाइंस रिपीट करता था और मुझे बहुत बहुत पावर मिलती थी। सो तब मैंने एक लेक्चर में शायद बताई थी, और मैं अब आपको बताऊं। सुनिएगा ध्यान से। एंड इट वर्क्स। बहुत छोटी सी पोएम टाइप की है, लाइक 4 लाइंस, और वो ऐसे है। इस दिल की धड़कन कहती है, उम्मीद अभी भी बाकी। तो जब आपको लगे आप बहुत डिप्रेशन में हो, अब सब टूट गया, नहीं हो रही पढ़ाई, कभी भी आपको लगे कि अब सब कुछ होपलेस है, प्लीज रिपीट इट। इस दिल की धड़कन कहती है, उम्मीद अभी भी बाकी है, ये रात कभी तो गुजरेगी, वो सुबह कभी तो आएगी। एक दिन ऐसा भी आएगा, एग्जाम का टेंशन उड़ जाएगा, और एक दिन ऐसा ही आएगा, मेरे नाम में सीए जुड़ जाए, मेरे नाम में सीए जुड़ जाए। तो प्लीज 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 हमेशा मोटिवेटेड रहो, पॉजिटिव रहिए, पढ़ाई करते रहिए। सब कुछ एक दिन ठीक हो जाए, ठीक है। और अगर अभी ठीक नहीं हुआ है तो इट्स नॉट द एंड, पिक्चर अभी बाकी है। एज आवर प्रोविजंस, पिक्चर अभी बाकी है। लेट्स मूव ऑन टू आवर प्रोविजंस। So illustration number 3 we have to solve now, and it's asked that discuss the taxability or otherwise of the following in the hands of the recipient. Akhil HUF received 75,000 in cash from niece of Akhil, that is daughter of Akhil's sister. Akhil is the karta of HUF. So provision says that if any gift is received from the relative, in that case that is exempted. So in this case, if you will go through the definition of relative, which is in above provisions, then you will find out that this is not the relative for the purpose of Income Tax Act. That's why the amount received is going to be taxable as income from other sources. Nitisha, a member of her father's HUF, transferred a house property to the HUF without consideration. The stamp duty value of the house property is so and so. So Nitisha is also the member of HUF of her father. And if any member transferred property to the HUF, that it is outside the purview of taxability under income from other sources. So that is not going to be taxable. Third is important. Mr. Akshat received 100 shares of A Limited from his friend as a gift on the occasion of his 25th marriage anniversary. We have discussed that gifts are exempted if it is received on marriage, not the marriage anniversaries. Clear? So technically he received 100 shares. The market value was 100 per share. So 10,000 is without consideration value, of course. He also received jewelry worth 45,000 from his nephew on the same day. That is 45,000. So total he received is 55,000, which is exceeding 50,000. So this is going to be taxable under income from other source. So in case of non-monetary item, you have to take the value separately and aggregate. If exceed 50,000, then it's going to be taxable. Kishan HUF gifted a car to son of Karta for achieving good marks in 12th board examination. The fair market value of the car is 5,25,000. So let's see. Can anyone you tell me the answer of point number 4? Kishan HUF gifted a car to son of Karta for achieving good marks in 12th board examination. The fair market value of car is 5,25,000. So can you tell me, is this going to be taxable in the hands of son or the Kishan HUF Karta, it's son of Karta? So you have to tell me, is it going to be taxable or not? I am waiting for your answer. Point number 4. Very interesting question, very simple question. Okay, Vishwanatha Reddy, you are here. I will give you the answer after this 1 or 2 question regarding the section 45(5)(a). You asked me in the last session. Okay. Okay, so Vaishali is saying car not included in gift. Vishwanatha Reddy is saying exempted. Correct. Car does not fall in the category of non-monetary asset, movable asset. There are 8 specified assets. Any asset other than those 8 specified, if received by you, does not fall under income from other source provision. So car, laptop, mobile, computer, etc. If it is given in question that you received it as a gift, then we cannot apply provision of income from other source because car does not include in these 8 specified assets. I hope it's clear. Non-taxable. Very good, Bhumika. Very good, Komal. Well done. Okay, these are the answers we have. Illustration number 4. That is, Mr. Hari, a property dealer, sold a building in the course of his business to his friend Rajesh, who is a dealer in automobile spare part for 90 lakh on 1/1/2023. So the person who is transferring technically his stock in trade, and the person who is receiving it, he is receiving as a capital asset because he is an automobile dealer and receiving the building. Clear? When the stamp duty valuation was 150 lakh rupees. The agreement was, however, entered into 1st September 2022 when the stamp duty value was 140 lakh rupees. Mr. Hari had received a down payment by 15 lakh by a cross check. So cross check does not fall in the specified mode of payment. So that's why we cannot take the value at the time of agreement. So the stamp duty value we should take, that is rupees 150 lakh rupees for the purpose of income from other source. Discuss the implication in the hands of Hari and Rajesh, assuming that Mr. Hari purchased the building for 75 lakh on 12th of July 2021. So Hari gives the property to the Rajesh. From the Rajesh point of view, we will solve the income from other source provision. And it says because the stamp duty value, which is the stamp duty value exceeding the consideration. Stamp duty value is 150 lakh, consideration is 90 lakh. So the difference is 60 lakh. So now as per the provision, we need to find out the higher of these two, 50,000 or 10% of consideration, which is 9 lakh. Whichever is higher is 9 lakh. So difference should exceed this 9 lakh and it is exceeding this, of course. Difference is 60 lakh. So technically 60 lakh will be income from other source in the hands of buyer, that is Mr. Rajesh. Clear? Would your answer be different if Hari was a share broker instead of a property dealer? No. In the hands of Mr. Rajesh, there would not be any difference in both the situations. The remaining income from other source in the hands of Mr. Rajesh will remain the same, whether he is a dealer in that or not. It does not make any difference in the hands of Mr. Rajesh. But yes, in the hands of Mr. Hari, they also ask the tax implication. What if he is the property dealer? What if he is the share broker? So if Mr. Hari was a property dealer, then he is transferring his stock in trade to Mr. So-and-so, and under section 43 CA, the provision will be applicable. Section 43 CA will say that 75 lakh is going to be taxable in the hands of Mr. Hari because the value was 150 lakh, and if you will see, then the valuation of business income taxability will be 75 lakh because the sale consideration as per section 43 CA, what we have discussed in earlier sessions of PGBP, the sale consideration will be taken 150 lakh. And that 150 lakh rupees purchase property value was 75 lakh. So the taxable value will be 75 lakh if that is a stock in trade in the under the head PGB. But if he was the dealer of shares, then this treatment in case of Hari will be under capital gain. That is also we have discussed section 50C. I am not discussing in detail because we have discussed these section 43CA under PGBP, section 50C under capital gain provision. So we are over here for Mr. Rajesh income from other source provision, what we just discussed. But you can see if the Mr. Ray is a share broker, then section 50C will be applicable, and 75 lakh will be your short-term capital gain. 150 lakh will still be the sale consideration. Purchase price was 75 lakh. Property does not held for more than 24 months. So difference is a short-term capital gain and is going to be taxable under capital gain topic. Compensation or any other payment received in connection with termination of his employment. So any compensation or any other payment due to or received by any person by whatever name called, if not chargeable under PGBP. So if that compensation is going to be taxable under PGBP, if it is paid to a person who managed the whole or substantially whole of the company, then it's taxable under PGBP head. If any other person receiving it, and if does not fall under PGBP, then it's going to be taxable over here for the modification or termination, etc. Income chargeable under the head income from other source only if not chargeable under the head profit and gains of business. There are certain incomes that can also be taxable under income from other source if they are not taxable under PGBP. Any sum received by an employer assessee from his employee as contribution to any provident fund, superannuation fund, or any other fund for the welfare of the employee. Income from letting out on hire machinery, plant, or furniture, where letting out of building is inseparable from the letting out of machinery, plant, or furniture, the income from such letting, interest on securities. Generally, interest on security falls under income from other source. But suppose in case of a bank, their main or primary income is earning interest on etc. security or loan. In that case, interest will go in their business income. The same way, if there's you are a broker and dealing in securities, you are an investment company, those invest etc. and the securities are your stock and trade, then interest will go under PGBP head. Otherwise, it will be taxable under income from other source. However, certain interest income arising to certain person would be exempt under section 10(15). So income by way of interest premium on redemption or other payment on notified security, bonds, annuity, these are general provision. I'm just reading it for you. There is no complication. There is no specific detailed concept. You just need to learn them. So certain interest incomes are exempted as it has been given in case of post office saving bank account. Post office saving bank account, it's very, very important. I have seen in certain examination questions, this post office concept actually disturb students a lot because they do forget that there is an exemption regarding the post office saving bank account under income from other source, section 10(15). So please remember it. It's very, very important. Please always remember this post office saving bank account interest always makes student in trouble in the examination. It was a very simple, very tiny provision. Generally, we forget about it. So if it is an individual account, 3,500 rupees is exempted. And if it's a joint account, 7,000 rupees is exempted. Interest on gold, deferred bonds, etc., specified bonds, these are any interest upon it, these are exempted from income from other source provision. Keyman insurance policy payment, it is taxable under PGBP head if received by employer. It is taxable under salary head if received by employee during his service, and it can be taxable under income from other source if it is not going to be taxable under salary head or PGBP. You can also read the provision. You might also have read provision in earlier chapter, chapter number 3. Residual income, any income which do not taxable under any other head of income is going to be taxable over here, like MP, MLA, salary, etc. These are going to be taxable under income from other source. Applicable rate of tax in respect of casual income. I have told you earlier in that picture that 30% is going to be taxable plus surcharge and cess on that casual income. No expenditure or allowance can be allowed. Deduction chapter 6A, that means section 80C to 80U cannot be claimed. And an exhaustive basic exemption, that is exemption limit if remaining, that can also not be utilized under casual income. It is going to be taxable at 30% fixed rate. What are deduction allowable under the section 57? Like if you are earning income under income from other source, then certain expenses can also be allowed under income from other source. And there are certain expenses, those are disallowed also. So when we will read this provision, you will see the connectivity with the PGBP provision. As under PGBP, it says personal expenditure not allowed. It will say over here also. Then if the expense on which TDS has not been deducted, that in some cases under PGBP, no deduction allowed. Up to the due of ROI if you deposit, then deduction allowed. In some cases, only 30% disallowed and 70% allowed. So those kind of provisions are again same under deductions allowable. and deduction disallowable. These are again very simple. In case of dividend or income in respect of units of mutual fund or income in respect of units of a specified company. Interest expenditure to earn such income is allowed as deduction subject to a maximum of 20% of such income included in the total income without deduction under this section. Only up to 20% of the expenditure can be allowed as deduction. In case of interest on security, any reasonable sum can be allowed as deduction. Income consists of recovery from employee as contribution to any provident fund. If employer deduct the amount of provident fund, I have told you that is going to be shown in the debit side of etc. and in the credit side, and if it is deposited up to due date of ROI, then it can be deducted as expenditure. The same provision is over here. A deduction will be allowed in accordance with the provision of section 36(1)(a) 5A, that is PGBP, to the extent the contribution is remitted before the due date under the respective acts. Where the income to be charged at this head is from letting on hire of machinery, plant and furniture, in that case you can claim repairs, insurance, rates, taxes and even depreciation if these are going to be taxable under income from other source. Same concept we discussed under section 30 and 31 of PGBP. You can see current repairs, premium and depreciation also going to be allowed under income from other source. Fifth point is important. It talks about family plan pension. So if any employee receive the family pension, then it's going to be taxable under income from other source, a sum equal to 33(1)(3). That means 33.3%, or we can say 1/3 or 15,000, whichever is lower, is going to be allowed as deduction. For example, any person receiving 75,000 as a family pension, then 1/3 of 75, it's 25,000, or 15,000 is the fixed limit. Lower, that means 15,000 is allowed as deduction. So out of 75, 15,000 will be deducted and balance 60,000 is going to be taxable value. For the purpose of this deduction, family pension means a regular monthly amount payable by employer to a person belonging to the family of an employee in the event of death. Some family pension is exempted. The family pension received by the widow or children or nominated heirs of a member of the armed force of the union where the death of such member has occurred in the course of operational duties in specified circumstances would, however, be exempt under section 1090. Like in a war, terrorist attack, etc., then the pension will be exempted, family pension. The family pension received by any member of the family of an individual who had been in the service of central state government and awarded Paramveer Chakra or Mahavir Chakra or Veer Chakra or other notified gallantry awards would be exempt under section 1080. Any other expenditure not being in the nature of capital expenditure can, in case of income by way of interest on compensation or enhanced compensation, I have told you only 50% is allowed as deduction. No other deduction is allowed. Example is over here that Mr. G during the previous year received 5 lakh rupees interest, out of which 5 lakh, 1,50,000 relates to 18-19, 165 and 185 to respective year. The provision says interest on enhanced compensation is going to be taxable in the year it is received, and 50% of it is going to be taxable under income from other source. Now, what are the deductions that is disallowed? And you will see that the allowable and disallowed both are quite resemble to the PGBP provision. Again, what are disallowed? Again, the same concept of PGBP. Any personal expenditure will not be allowed. Any interest charged to tax under the act which is payable outside India. You remember, when you pay any payment outside India under PGBP, it is allowed if TDS has been deducted at source. So it says if TDS has not been deducted or paid, you cannot allow that interest out of income from other source expenses. The related party provision, of course, there, if you pay any person who is your relative or a specified person in excess of the FMV, the excess amount is disallowed under PGBP. Same copy paste provision is over here. And again, there was a PGB provision which says if you pay 10,000 or more, exceeding payment 10,000, same person, same day, in cash, etc., then the whole amount is going to be disallowed. The same provision is over here also. In my opinion, the most important part under income from other sources is deemed dividend. Then FMV of shares concept, which says that shares are issued more than the FMV is going to be taxable, was a very important concept. Then an important concept, the post office interest one, and the most important is gift provisions. If the examiner wants to prepare a question out of income from other sources, I believe that the gift provision are the most important, and the kind of provision they are going to ask you, but that does not mean that I am saying do not read the other provision. Each and every provisions are equally important. So read each and everything carefully. Disallowance of 30% expenditure if the payment is made to a resident. Then even if you did not deduct the TDS, 70% is allowed and only 30% is disallowed. Even income from other source, same concept is there. No deduction in respect of any expenditure incurred in connection with casual income. We have discussed that you cannot deduct anything from casual income, not even expenses, no allowances, no deduction, not even the basic exemption limit. No deduction in respect of any expenditure or allowances connection with income by way of earning from lottery, crossword puzzles, races including horse race, card game, etc. The prohibition will not, however, apply in respect of the income of an assessee being the owner of the racehorses. Suppose I am going to a horse race event and I am going to bet upon the horses. So if I won something, that is my casual income. And out of that income, I cannot deduct the ticket value or expenses made by it. That is going to be full taxable. So that is casual income for those persons who are technically doing betting upon the horses. But the person who is the owner of that horses, those are running. And if the horse win, then in that situation, that is not his betting income. So we are saying that this prohibition that we cannot deduct any expenditure is upon those persons who are doing betting, etc. But this is not applicable to that person who just maintain and own that horses. For that person, expenses on the maintenance, etc. is allowed. You will read it detail in set off of losses chapter, in which there is specific provision for carry forward and set off of losses in case of owning and maintaining race horses. So just need to clarify you that the person who is betting is different, and the person who is maintaining those horses, etc., does not fall under casual income. For that, a specific provision, the activity of maintaining horse races has been prepared. The provision has been separately discussed in section 74A, that is set off of losses. Method of accounting, it says income from other source has to be computed in accordance with the cash or mercantile system of accounting regularly employed by the assessee. PGBP head or income from other source can be maintained on mercantile or cash system. All others need to be maintained whichever is earlier. Income accrue, rise or receive, whichever is earlier. So that was the concept of income from other source. All provision we discussed. We are left with our MCQ and test your knowledge questions. Let me see if there's any question. The plot at Faridabad is purchased in 2009. It's transferred to give to Mr. A. So cost of acquisition, the period of holding of previous owners to be considered as per capital gain. Then why it is treated as short-term cap gain? Because we are solving it. The person who transferred it. Let me see. We will do one thing. We will complete our test your knowledge provision. Then we will come out to your question. Okay, Mr. Mohammed? I guess you also asked in case of capital gain. In case of capital gain, there is also some question asked by Mr. Mohammed. Let me explain it. If it happens that we have sold multiple properties under capital gain, the question was like this, that Mr. A having 3 houses and he transferred all 3 houses in the previous year. And out of the gain of all three houses, he wants to purchase a single residential house. So can the multiple house sale consideration can be used for purchasing a single property? The answer is yes. The act has not restricted it, and we have the judgment against some case laws that yes, if you are transferring several houses, I have three houses. From one house, I had a capital gain of 30 lakh. The second house, I have a capital gain of 40 lakh, and the other house, I have a capital gain of 20 lakh. So total, I have 90 lakh rupees capital gain from three houses transfer. Now I want to invest in a one big house. Value is 95 lakh. So can I claim all three capital gain exemption? Transferred houses are multiple, and I want to purchase a single house. So can we claim the 95 lakh rupees exemption out of the three capital gain of the multiple properties for a single house? The answer is yes, it is allowable as per some judgment has been given by the department in some different cases. If you want to know the judgment, you can Google it, or if you want to know, I will share it with you, of course. Rate of surcharge depends upon the person income, of course. It depends upon income is exceeding 50 lakh or 1 crore or 5 crore or 2 crore, as per the surcharge provision that might have been discussed with you in the chapter 1. Okay, Bhumika? Okay, there is no more queries. So let's complete this test, your knowledge provisions. Examine under which head the following incomes are taxable. Rental income in case of property held stock in trade for 3 years. Okay, let me wait for your answer. Question number 1. Rental income in case property held as stock in trade for 3 years. This is going to be taxable where? In which head? Read it carefully and then give me the answer. Okay. Singh Rajiv Kumar saying income from other sources. Okay. Bhumika is saying income from house property. Vaishali Bindal is saying PGBP. Wow, 3 answers and we have 3 different answers. Brilliant. Excellent. You are doing really good. Wow. Okay, the correct answer is income from house property, because in the income from house property, if the property held as stock in trade, then up to 2 years, its value is going to be taxable as nil value. From the 3rd year, it's going to be taxable as deemed let out. So when the property is assumed as deemed let out, it's always going to be taxable under income from other sources. Manisha was correct and Bhumika was also correct. Okay. Mohammed, no, it's wrong. It's PGBP head, nahi, it's income from house property. The second is salary received by a partner from his partnership firm. Okay, first answer I have shown you, now second. Salary received by a partner from his partnership firm. Send me quickly in which head is going to be taxable. A partner receives salary from his partnership firm, where it is going to be taxable. Okay. The correct answer is, of course, PGBP, because under partnership firm and partner, there is no relationship of employer-employee. And I have already told you, anything which is received by a partner from partnership firm, like interest on capital or loan, salary from partnership firm, and profit share, they all are going to be taxable under always PGBP. Clear? Rental income, it's very simple. You can see profit and gains or income from other source depend. Winning from lottery is casual income, that is going to be taxable under income from other source. Salary payable to a member of parliament, income from other source. Receipt without consideration, income from other source. As you can read it out, it's very simple. Question 2, examine whether the following are chargeable to tax and the amount is liable to tax. A sum of 120 was received as gift from non-relative by Raj on the occasion of the marriage of his son Praveen. This is going to be taxable because the amount is received by Mr. Raj, not the son on the marriage. The marriage is of his son. So if the son received the gift, in that case, that can be exempted. But Mr. Raj received on the marriage of his son, that is going to be taxable in the hands of Mr. Raj. Interest on enhanced compensation, 96,000, 40% relates, etc., whatever it is. Half value is going to be taxable. That's a fixed concept. 48,000 is going to be taxable. Question third, that's the same question, which is in study material, that 5 lakh received on as an interest on enhanced compensation. How much is going to be taxable? 2,50,000 is going to be taxable. Now, last question from Test Your Knowledge. Following details have been furnished by Mrs. Hemali pertaining to the year ended 31st March 2023. Cash gift of 51,000 received from her friend on the occasion of her Shasti Patha Purthi, a wedding function celebrated on her husband completing 60 years of age. This was also a 25th wedding anniversary. So anniversary gift received on anniversary is going to be taxable. 51,000 is going to be taxable, of course. On the above occasion, a diamond necklace worth rupees 2 lakh was presented by her sister living in Dubai. So sister falls in the definition of relative. And any gift, any time, any value received from relative is going to be exempted, that is non-taxable. When she celebrated her daughter's wedding on 21st February 2023, her friend assigned in Mrs. Hemali's favor a fixed deposit, FDR, held by the said friend in a scheduled bank. The value of fixed deposit and the accrued interest on the said date was 52,000. Now the problem is, does FDR is a monetary payment or not? The problem is this. There's a confusion. This is not specifically written that bank FDR, etc., will be treated as a monetary payment or not. So if FDR is treated as the monetary payment, this is debatable, argumentable. So if it is technically monetary, then 52,000 is going to be taxable. And if FDRs is non-monetary payment, then in that case, this 52,000 is not going to be taxable. So there is no specific provision regarding the FDR because it is not included in the definition of those 8 assets, specific movable assets, and not in the monetary value. It is not specified that FDR, etc., is monetary value asset or not. So both view we have, and in the answer also, the both view has been taken. So you can read the answer of this question and you will be able to understand exactly what is the provision regarding it. We have question 5 also. Question 5 is regarding again Mr. B transfer 500 shares of RP Limited on 10th October 2022. $3 lakh when the market value was 5 lakh. The index cost of acquisition of share for Mr. B was computed at 445. The transfer was not subject to security transaction tax. Determine the income chargeable to tax in the hands of Mr. B and Messrs. B Company Private Limited. So the receiver is Messrs. B Company Private Limited, who is receiving 3 lakh rupees shares. The market value is 5 lakh. So 2 lakh is the income from other source in the hands of Messrs. BP and Company Private Limited. Clear? And for the purpose of Mr. B, there is capital gain concept. The 5 lakh rupees selling price and the index cost of acquisition is 4,45,000. So the balance will be 55,000 will be capital gain in the hands of Mr. B. Mr. So-and-so, Shazian is employed in a company with taxable salary income 5 lakh, received a gift 1 lakh from Atma Charitable Trust, registered. So any gift received from a registered trust is going to be exempted, not going to be taxable under income from other source. There's a solution, you can read it. Okay. So we have done with our test your knowledge provision, but there was a question from Mr. Mohammed regarding the illustration number 2, I guess. Let me take that question. That question says, he was asking that in that question, why did not we apply the provision of Manjula J. Shah, etc.? Because we should take the cost of acquisition of the previous owner, etc. Correct, Mohammed? We can take that view also. to solve the question from the point of view of the seller. But in this question, we did not take that view. That's why we have already written in the note. The resultant capital gain will be short-term cap gain, since for calculating the period of holding of previous owner is not to be considered. So if you want, in another view, we can take that, yes, we can calculate the capital gain provision. Also, with the help of the provision we have discussed in the capital gain section also. That can also be a possibility. Okay. Next, moving on to our now MCQ test. I hope you all are ready for it. Okay, before that MCQ test, Mr. Reddy asked me a question. Let me solve that question for him. Otherwise, he will feel sad. So, the question regarding section 45.5, and for that I need to take the question out, and then for all of you, you can understand the question. I will let you know what the question is, and then I'll solve it for you. So Mr. Reddy question was this. I am taking the main question part, which is relevant for us. That Mr. A, who joins a inherited property of 3 acre. He has a property of 3 acre residential land in Bangalore. It's section 45.5A provision. Enters joint development agreement with Mr. B. Joint development agreement with Mr. B. And it start on 15/5/2013. So this is the date of transfer technically, but because Mr. A do not have any income, so we cannot charge it in this year. We have to, chargeability year should be different from this. And Mr. B complete residential apartment on 31/12/22 as per the sharing agreement. Mr. A own 165 flats out of 390 flats. So I have taken an assumption that Mr. A having 165 flats, that's what he transferred his residential land for this purpose. Balance flats belong to someone else. I assume that because in the question it has not been written that balance flats belongs to Mr. A or no. So we have considered that only 165 flats belong to Mr. A property, that is 3 acre land. Clear? Now the transfer year we all know. Now the provision says if the share has been transferred after the completion certificate issued by the competent authority, then that year will be your chargeable year. And if the share transfer before completion certificate, then that year in which the share transfer will be your chargeability year. So in this example, the authority did not issue certificate yet, but he transfer is 5 flats. So that is the case of before. So it says that 5 flats sold by Mr. A on 30th October 2022 for a sale consideration of 3 crore rupees. So our sale consideration is 3 crore. Now period of holding, if we say it is an ancestor property, so we do not have the period of holding of ancestors. So we assume it is before 2001 and the sale year is this. So that will be a long-term capital asset. Transfer year is this. Now for the purpose of solution, we need to know the cost of acquisition. We will convert it into the index cost of acquisition. For the purpose of cost of acquisition, there's multiple things has been given in the question. That on 1st April 2001, the stamp duty value of the property was 3 crores, 60 lakh for each. 60 lakh for each. So we are technically each acre. So he had 3 acre property. That means the value is 1 crore 80 lakh rupees. Stamp duty value is this. And the FMV value also given on 1st April 2001, which comes to, I have made the calculation. The square feet information has been given. 1 acre having 4,3. It has been given in question. 1 acre is equal to 43560. and square feet value is given 250 rupees per square feet. So the value of 3 acre comes to, if you will find out, the 1 acre value will come 1089,0000, and for 3 acre value will be 3267,000, like 3 crore 27 lakh. So the property those are purchased or received before 1/4/2001, the provision says the FMV or purchase price higher we will take. So technically we should take the FMV, but listen carefully. In case of land and building or immobile property, the FMV on 1/4/2001 cannot exceed the stamp duty value. So might be you will take this value for cost of acquisition, but that is wrong. In the provision it has been written, you can check the notes page number or study page number, sorry, in study page number 4.386, it has been written cost of acquisition for the purpose of other asset, that in case of land and building we cannot take FMV if it exceeds the stamp duty value. So the index cost of acquisition purpose, our cost of acquisition was 180,000,000, and this is for my 165 flats. On that property has been constructed, out of which only 5 has been sold. So the cost of acquisition will be 545454. So cost of acquisition for these 5 flats are 545454. Multiplier will be this previous year 1314 index, you should find it out, and 100 will be your this index. You can deduct it, and that will be your long-term capital gain. So in this question, some informations because not given, so we assume 1 or 2 information. So this will be your treatment for the purpose of this question. I hope it is you're happy with Mr. Vishwanatha Reddy. Okay, balance. Vishwanatha is saying balance flats belong to developer, sir. Then okay, if balance is, we assume that 165 only belong to the Mr. A. So on the basis of that, that is a solution for section 45(5)(a) questions. Now we can move on to our MCQ sheet. So are you ready for the MCQs? Mohammed, you are asking now me the PGBP question. This is not good. This is seriously not good. You cannot ask an income from other source the PGBP concept. I do not have that time. Beta, please, it's a request. We cannot answer these kind of question. Or this question, what you are asking, I have already answered you earlier also in the PGBP. You can refer the section. An asset which is used for scientific research sold at a price which exceeds deduction claimed under section 35. In that case, for calculating capital gain, full value of consideration is taken as the wholesale consideration for the sale. You are asking a wrong question. Okay. So please go back to the PGBP provisions. I have explained this question with the help of an example also. You can please watch that class and you might get the benefit, or you may be able to solve this question by yourself. Okay, so you are ready, Vishwanatha. Do not, multiple questions should not be asked. If what happened in that question, I have solved not that question for you. Please do not insert extra condition into that question. That will be complicated because section 45(5)(a) is still not clear. There are a lot of argument, debates are in this section and still debatable on many things. So if you insert a new point in that question, sir, what if same flats are sold after OC received by authority? Then in that case, the year just changed. The year will change. The year which what we take for the purpose of capital gain is, because he sold in this year, so that is assessment year 23-24. So if we transfer his share after receiving the completion certificate, in that case, that year will be your previous year, and the assessment year in which the certificate has been received is going to be chargeable year. That's it. All the provision will remain the same. Okay. Fine. So I hope you all are ready for the MCQ now. Now see, you ask me a lot of questions every time. Now it's your turn to give the answer. So after MCQ, we will close our session. Before that, let me ask you question one by one. Some are very easy. I already framed easy question for you because you do not have that time for today's sessions left. Which of the following incomes are chargeable under that income from other sources? Please give me answer as fast as you can, just like a flash. Okay, so the first question, which of the following incomes are chargeable under the head income from other source? Let's see who is going to give me the answer first. It's very simple. Okay, the correct answer is, of course, D. Dividend is also taxable. Winning from lottery also, and betting income also going to be taxable under income from other source. Second question. Believe yourself. मैंने जो poem सुनाई है उसे याद रखना. It's very powerful. Whenever you feel depressed और आपको लगे कि आप अब नहीं कर सकते आगे, हमसे नहीं होगा, प्लीज उसको 3-4 बार रिपीट करो एंड आपको फील होगा कि होगा, आपसे ही होगा. जब हमसे हो गया तो आपसे क्यों नहीं होगा? Okay, so Rakesh acquired a motor car for 3 lakh from his friend, non-relative. When FMV of the motor car was 5 lakh, the amount liable to tax. Question number 2, correct answer I am waiting. And the correct answer is, of course, D. Well done, Rushita. Well done, Rajiv Kumar, Manisha, Vaishali, Kavita. Well done, because car is not a capital asset for the purpose of income from other source. A lady received gift worth rupees 1 lakh from a relative as defined under the Income Tax Act 1961 and 60,000 from her office colleagues on her marriage anniversary. The taxable value of gifts would be. Yes, Bhumika also gave the right answer of question number 2. Well done. Komal also gave the correct answer of question number 2. Now the question number 3 is in front of you. After today's session, please अपनी पढ़ाई ठीक से कीजिएगा. All the very best to all of you. Please work hard. Please learn that अपनी mistakes से सीखिए. अगर कुछ नहीं हो पाया है तो please learn from mistakes. So if you are on failure, learn from it. So failure is also give you a lot of experience to become a successful person. So failure is as important as your successes. Okay. So be on it. I request the Board of Study to conduct meetings of all the faculty with the students. So they'll interact them live. If it's possible, it will be really good to see all of you. So possible, might be some Board of Study will listen to this request that there must be a meeting between the students and the faculties. So that will be a face-to-face meeting in anywhere in India. That will be really good for students and as well as for the faculty. So what is the correct answer of question number 3? The correct answer is, of course, B, because relative gifts are exempted, but other than relative gifts on the anniversary is going to be taxable. Well done. Fourth. Mr. A received drawings, paintings, okay, worth rupees 1 lakh as gift from his friend on 20th April 2022. The taxable amount in the hands of Mr. A, very simple, it's 1 lakh rupees, okay. Akshay received a gift check of 35,000 each on 22nd of May 2022 from his 3 friends. The amount charged to tax in this case will be B, 1,05,000. I'm giving you answer because we do not left with much of time. Richa received gift of jewelry, FMV of which 3 lakh on 17/10/22 from her fiance. Fiance is not husband. Okay. What will be the taxable amount? So technically, it's going to be taxable. The correct answer of this is B. 3 lakh is going to be taxable because fiance does not fall in definition of relative. Mohan received a watch worth rupees 60,000 from his cousin, grandfather, brother of his grandfather. What will be the taxable amount? Again, the watch does not fall in these 8 specified asset definition. So from whom it is received does not matter. That is going to be non-taxable. The correct answer is A. On 30/12/2022, Raju gets gift by a commercial flat from the elder brother of his father-in-law. Stamp duty value is 25 lakh. The amount chargeable to tax is. So elder brother of his father-in-law does not fall in the definition of relative. Because does not fall in the definition of relative, whole 25 lakh rupees will be income from other source. Rajesh gifted an immovable property for a consideration of 70 lakh. The stamp duty value and the date of agreement is 90 lakh. Whereas the stamp duty value on the date of registration was 98 lakh 50,000. Part of the amount of registration of 34 lakh has been received by check on the date of agreement for the transfer of the asset. What will be the taxable amount? Okay. Question number 9 answer I am waiting. You should give me that question answer because that is a question which is really relevant for yourself and it's also important. So question number 9 answer I am waiting. You have to apply that provision in respect of inadequate consideration for immovable property. The difference of something should exceed the higher of something. I've told you. So please apply that and give me the correct answer. Manisha just solved it and give me the correct answer. Wow, D, correct. Because we need to take the difference, that is 20 lakh rupees. The stamp duty value, date of agreement we will take because it has been paid via check. So 90 or 70, difference is 20 lakh. Now we have to take the 50,000 or 10% of consideration, that is 7 lakh. So higher is 7 lakh and the difference is exceeding this 7 lakh. So that is going to be taxable is 20 lakh. Last question, you can solve it yourself. It's very simple. So we are moving to is there any technical glitch? Okay. So we have actually completed our questions and our, of course, whole syllabus also. So from my side, all the best to all of you. Please complete your studies. And the session is over. So we will see each other very soon. I hope. Please, please, please work very hard. So Manish ji, can we close the session?